In this lecture, we will explore the topic of debt management, managing debt effectively. By the end of this lesson, you should be able to review the client's debt situation and offer recommendations for optimal debt management. Evaluate the impact of reducing or increasing debt on a client's ability to reach goals. And explain debt refinancing and debt consolidation. All debt is not necessarily bad. It is certainly needed by most individuals to purchase a family home and to acquire assets early in a career, including funding and education that enables the person to fulfill their dreams, their purpose. Used prudently, debt can help the client's estate or business grow and help secure a quality lifestyle in retirement, and that's utility. In some situations, the investment return on the asset produced by taking out the loan exceeds the cost of the debt, and that's positive opportunity cost. On the other hand, used improperly, debt can be a lifetime burden on reaching goals. For example, using high-cost credit card debt to purchase depreciable personal property, including electronics, clothing, expensive automobiles, will negatively impact one's ability to fund prioritized goals. Moreover, debt may create a psychological burden that could keep the person up at night, or worse yet, adversely affect their happiness and well-being. Contextual variables to consider in making debt management recommendations include the client's income level, their stability of future cash inflows, their net worth or financial capacity, their life or professional stage, and how that relates to projected future earnings, and other issues such as health concerns, change in family status, and special family circumstances. The financial planning industry uses 3 debt ratios as benchmarks to determine if the amount of client debt is reasonable. These ratios are the consumer debt ratio, the housing debt ratio, or PD, which is principal, interest, property taxes, and home insurance, and the total debt ratio, which is the sum of consumer debt and housing debt. The consumer debt ratio compares all debt other than the housing costs, such as credit cards, car loans, student loans, personal loans, alimony, relative to take-home pay. The rule of thumb states that this ratio should be less than or equal to 10 to 15% of take-home pay, and it should not exceed 20% of take-home pay. The housing ratio compares the cost of the mortgage, which is principal and interest, taxes, and home insurance on gross income. This ratio should not exceed 28% of gross income. The total debt ratio, consumer debt and housing, is pegged at less than or equal to 36 to 38% of gross income. 4 important debt management strategies are mortgage refinancing, debt consolidation, accelerated debt repayment, and negotiation or bankruptcy. There are several reasons to refinance. The most obvious reason is to secure a lower interest rate. Moving from an 8% loan to a 5% loan would certainly reduce the monthly payment. But there are several other reasons. Extending the loan duration, the term of the loan, to reduce the monthly principal and interest payment. Convert from a variable rate loan to a fixed rate loan, or vice versa. To remove the cosigner off that original mortgage or loan, for example, a parent, maybe an ex-spouse, or to eliminate mortgage insurance, although many lenders will drop the mortgage insurance now from the original loan once the home's equity exceeds the 20% of the loan balance. Let's walk through an example. You're given that the client purchased the home 14 years ago. The original loan amount was for $384,000. The terms of the loan, 30-year, 8.4% fixed rate mortgage. Given that information, does it make sense financially to refinance with a 15-year, 5.8% mortgage? And note that the refinancing will cost 2 points. In working with your client, you will have loan statements that show the monthly principal and interest payment. However, for educational purposes, you'll see how it can be calculated using a financial calculator with a time value of money function. You'll learn how to calculate this in your Financial Principles and Policies course. As you see, the loan payments are paid monthly for 30 years. So that's 30 times 12 or 360 payments. The annual interest rate is 8.4% or monthly 8.4 divided by 12, which is 0.70% monthly. The original loan amount was $384,000, and at the end of the 30-year period, this amortized zone will be paid down to zero. Solving for the payment, the monthly payment, you would get $2,925. Next, step 2, determine the remaining loan balance owed on the 30-year 8.4% loan. Now, each month, a portion of the loan payment goes towards repaying principal, and a portion goes towards servicing the interest on the debt. As you might expect, in the beginning years, most of the monthly payment goes toward the interest because there's still a lot of principal. As principal is paid down over the years, the amount of interest per month is smaller. The amount of principal repayment is larger. Based on the calculations, after 14 years of payments, only about $75,600, the original loan, was paid off, leaving that loan balance shown there of $308,417. Step 3. The calculator inputs for the new loan are shown on this slide. Remember that the loan is going to cost 2 points. So the amount needed to repay the loan and to roll in the 2 points is 102% of that $308,417, or the new loan would be for $314,585. It's for 15 years, 12 payments a year, so that's 180 payments. The monthly interest rate would be 5.8 annual divided by 12. At the end of the 15 years, the loan is totally paid off. So solving for the payment, you get $2,621. Comparing or reconciling the payoffs pattern for both of these loans, you see that the new loan will save about $305 a month. Over the life of the loan, that's almost $90,000. Your client's going to be really happy to see this savings, and you'll be able to identify ways to use these surplus cash flows to fund prioritized goals and planning needs. Let's take a few moments to review a few terms, mortgage terminology. A point is a charge for the interest rate received. 1 point equals 1% of loan value. So example, let's just say you're locking in a 4.5% loan for a 30-day period of time. That might be priced at 4.5% plus 1.5 points. The down payment is the amount of money that the borrower needs to contribute in order to qualify for the loan. And that's typically going to be 20% of the home costs. A no-cost loan isn't really no cost. Yes, the lender credits back the cost of the non-recurring origination costs. However, the loan's interest rate is higher than if you paid those origination costs. Those are closing costs. Typically, the break-even is around 5 years. So if you intend to stay in the home for a long period of time, you might be better off by paying the costs rather than having the lender. Closing costs. They include a number of things, including the cost of the credit report, the lender's loan origination paperwork, which, by the way, is tax deductible, the homeowner's inspection, the appraisal fee, the title insurance, a title search, the amount of money you need to put in escrow to cover a few months of property taxes and private mortgage insurance if that's needed, recording fees, and lender underwriting fees. Why consolidate debt? Well, there's several reasons to consolidate debt. You might lower the composite cost of the debt. You might be able to gain tax deductibility. There would be ease of making one monthly payment rather than several. And to change the terms of the loan. For example, the loan maturity, fixed or variable rate. Remember, if you consolidate and move to a fixed payment home equity loan, then you need to ensure that your client has adequate income to service the fixed monthly principal and interest payments. One advantage of high cost revolving debt is that you're free to make just the minimum payments. There's flexibility there. Let's walk through another example. In this case, your client has 3 credit cards. A bank credit card costs 12.5% APR. There's a $35,000 monthly loan balance and with a credit limit of $50,000. There's a retail charge card there of 14% APR, 8% monthly loan balance with a 10% credit limit, and an affinity credit card of 10.5% APR, 18% monthly loan balance with a $20,000 credit limit. The question that we're looking at, what is the financial impact of consolidating these 3 revolving credit loans with a 15-year 6% home equity loan? Applying the respective annual costs of the revolving debt to the respective loan balances, and assuming that those loan balances stay consistent through the year, even though there's a 2% monthly repayment of loan balance required, you see an out-of-pocket expense for the 3 cards of about $8,600. Given that the client's approved for a 15-year home equity loan with that 6% APR and needing $61,000 to pay off those 3 credit cards, the monthly cost $514.75, or 12 times that would be $6,177. However, part of this out-of-pocket expense is saved since the home equity debt is tax deductible. Assuming a 28% marginal tax rate, the savings is $1,005. So subtracting that from the $6,177, you get an annual cash outflow for this home equity loan of $5,172, approximately $5,172. And subtracting that from the $8,605, you can see that there is a total annual savings in the debt consolidation of $3,433. Again, you're going to have a relieved client. In many circumstances, cash flows may be maximized by accelerating the debt repayment. Now, if the circumstance is such that a client's in a position to do that, for example, they received a cash windfall, perhaps from an inheritance or a gift, there was a bonus, the client's generated discretionary cash flow because from prudent budgeting, then consideration must be given as what debt should be paid off first. 4 items to consider when determining the order of the debt repayments are the cost of debt, and you would look at the annual interest rate, the annual fees, and the institution's method of calculating balances. The income tax implication, is the debt tax deductible or not? Is there flexibility in the monthly debt payment? Is it a fixed amortized payment? Is there only minimum monthlies required? And are there any debt characteristics that are positive for you or the client? Is it secured? Is it unsecured? Is there possibility to negotiate terms? Your overall assessments of the pros and cons for these four areas will help you determine a schedule for what debt should be paid off first. Now note that if you're partially prepaying an amortized loan, the monthly loan payment is going to remain the same. It's not going to go down. However, the prepayment will reduce the total number of years payments get made, or the number of months that the payments get made, and it will lower the overall amount of interest paid on this amortized loan. In this lesson, you learned about contextual variables that impact the recommended debt repayment strategy. You learned about refinancing a home mortgage and consolidating high-cost non-deductible debt into a lower-cost deductible home equity loan.